Global trade policy, tariffs, uncertainty, market volatility, and fear. Those are words that we could probably use to describe this week, certainly the last 2 days. My name is Steve Higgins, financial advisor here at Higgins and Schmidt Wealth Strategies in Denver, Colorado. Now, while the market has been struggling maintaining balance over the last month, it was really the last few days where we really hit a crescendo in terms of the market volatility. We've seen indexes now down about 17% for the S&P 500. The NASDAQ is in bear market territory. We're really seeing across the board market struggle to maintain footing against the uncertainty that we're seeing in response to the administration's release of the new trade policies, the tariffs, and things like that are coming out. Now, listen, I am not going to project myself as a global trade or a tariff expert. I am not. And if we're being realistic, neither are you. I'm a financial advisor. My goal is to help clients meet long-term goals and objectives. You're an investor, probably trying to do the best job that you can do to fulfill your aspirations, dreams, and goals for your family. So in that context, let's talk about how we face challenges like we're facing right now, which from a 50,000 foot view, volatility is not new. Market volatility is a standard, it's the norm. However, each narrative of each event is definitely different. Now, last week I put out a video and I talked about fear, and I think that that was really timely. And I would suggest that you go back and look at that. And what we're talking about is how do we respond in the short term to fear. Using that fear, that emotional response, really disallows us from focusing on the long term, because fear, as a short term emotional pain mitigator, really doesn't care about our future selves. So in that context, let's talk a little bit. I'm going to be brief today. In the spirit of Casual Finance Friday, this is going to be extra casual. We've got a lot of work to do for our clients right now to help navigate from and find opportunity in these environments. So I want to make sure that most of my focus is on that. But I did want to make sure that I sent something out to everybody because I want to be consistent. Because I did promise you that. So, so with the tariff announcements, what we saw were all kinds of tariffs on countries we already had tariffs on. 60 reciprocal tariffs were basically matching tariffs coming from other countries to the U.S. All of these different things have really just created this uncertainty that has caused the market to drop, and I think it's justified. I think markets benefit in times of certainty and they struggle in times of uncertainty. However, I don't think that this changes the focus or the idea that process wins every time. So 3 things I want to make sure that you understand, 3 things that I'm going to make sure that our clients are always certain that we're taking care of, that we have at the forefront of the work that we do here. Number 1, diversification works. Throughout this volatility, what we've seen is diversified portfolios that are made up of different asset classes, really designed to mitigate and weather these types of storms, have done really well. In fact, I think I might be able to make the argument that diversification is working as well today as it has in the last 2 decades. And that's a very, very good thing for the clients that we serve. And number 2, disciplined process is key. A disciplined process would be defined as an investment objective that works in concert with a long-term financial plan and that we stick to it. If you have a plan and you have a process that's designed to weather storms and benefit from long-term opportunity, then you got to stick to that plan even when it's the most painful. And I think what we're experiencing now is one of those times. This is a painful moment. Number 3, portfolios should reflect income and liquidity needs. So if you have known income or liquidity needs in the near future, we would call that in 5 years or less, that needs to be reflected into your portfolio. You need to make sure that you have safe assets. It doesn't need to be cash, but you need to make sure you have less volatile assets, not subject to market volatility, ready to fund those liquidity needs so that you're never in a position to have to sell to meet a known need. We take care of that for our clients. We think it's very important. It's one of the most important things that we do, and we suggest that you do the same. Now, before I leave you, I want to kind of bring you to this chart. I had promised not to put a lot of charts up on Casual Finance Friday videos because I do want this to be very efficient for you and also for me. But look at this. What we're looking at are total returns and market pullbacks for the S&P 500 since 1990. Okay? And when we go back in time, we see the blue bars, those represent the annual return of the index. Now, the S&P 500 is just really a broad measure of large cap U.S. Domestic stocks, and it's really considered a proxy for the overall U.S. stock market. So the blue bars, those are the annual returns. Now, the red dots, What you see there, that is the lowest point or the maximum drawback in any given year. So what you can see here is market volatility, even double-digit market volatility, is absolutely normal. And while 80% of these years, relatively 80% of these years are positive, almost every single one of them experiences a moment where you probably think that maybe this time is different. Now, what I would ask you to do is just play a game with yourself. Zoom in and look at each one of these years and look at the low point. And ask yourself if you can remember what it was, what was the source of pain or the source of the market uncertainty that made it harder for the markets to price assets in that moment. My guess is that maybe a few of these you would understand. You could see 2020, that's a negative 34%. Like we all know what happened in 2008, 2009, where you see this negative 48%. But look at some of the negative 29%. Negative 12, negative 10, negative 7, negative 19. Today we said about 17% off the all-time high in the S&P 500. So certainly not irregular in the context of history. But ask yourself, are the things that are happening today worth derailing your long-term goals and objectives, your aspirations for you and your family? Probably not. If you would like this chart or anything else that we can do for you, please don't hesitate to reach out. My partner Allison Schmidt and I, we're very proud of the firm that we have here. We've got great financial advisors on our team, including Molly Cooper, amazing staff and support people that can really come to the table and meet this challenge. This is when we are at our best. This is why we do what we do. So with that, despite the market volatility, despite the uncertainty, do not let that distract from what's most important, and that's the long-term goals and objectives. And also, have a great time this weekend. And I don't want to forget to say, Happy Friday.